Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. Today, I thought it'd be kind of interesting to go through some various mutual fund companies and investment advisory firms and see what they give for portfolio recommendations. I'm going to use the same sample of, say, $50,000 starting, and we just go through the models that we have and see what the results are. We'll use T. Rowe Price. We'll use USAA as well using this episode. Next one will be T. Rowe Price. Next one will be Vanguard. We'll see if Fidelity and Schwab offer these models as well. It'll be pretty interesting. So we're going to show you the USAA one first. And I'm fond of USAA, been a member of USAA for many years, going on 40 years now, as a matter of fact. And USAA runs deep in our family, with my granddad had been a member back in the late 40s or early 50s or something like that. So 4 generations of USAA membership. Very fond of the firm, used to work there for 10 years. So we're going to start with them. So let's just, you got to log in to USA.com. All right. So you got to log in first. And that if you don't have a USA account, it'd be obviously tough to do that. But anyway, you log in and then you scroll down, you go to the product recommendations, investments. And here I'm going to say, I want to get a recommendation. So I'm going to click on this right here. And then say 5 to 10 minutes, USAA Portfolio Planner. That's what I was looking for, the USAA Portfolio Planner. So I'm going to click Get Started. All right, let's start a new plan and see what comes up. So this is how you say, well, I don't know what to do. I'm not sure I want to pay somebody. So I'm going to have USAA, their algorithm spit out a model for me. And again, I am logged in here. And what I did is I went to products, and then it'll give you a drop down for investments. And that's where I went here. So we're going to call this, we're not going to call it anything. We'll say we have $50,000 to invest, and I want to grow my money. All right. So I'm going to grow my money, and I want my investment style. I'm just going to follow the prompts, is we're going to say aggressive. And I want to manage my own investments with the help of professional advice and research. They got 2 options here. I prefer to manage my own investments with the help of professional advice and research, or I want a professional to manage my investments portfolio for me based on my financial goals. We'll actually try both. But for right now, we'll go over I'm going to do it myself with the help of professional advice and research. So a little bit confusing about what the difference is. I haven't worked there. I know what the difference is, but that says, well, it's professional advice and research. That, I guess that just means I'm making the trades myself, which is what it does. But I'm not sure that you would know that naturally. So I'm going to say I have money left over that I'd like to save and invest. I'm going to say my net worth is $250,000 or above. I'll say I'm a moderate knowledge of investments. Do I think I'll need the money I'm setting aside to cover other expenses? I'm going to say no. Well, let's just keep going down here. There we go. I'm going to say I'm in the 22% tax bracket. And again, you can mess around with all this to change it. Or I'm saying I'm married, filing jointly, excuse me. I'm in the 22% tax bracket, which would be right there. We'll say, and then I'm going to go down here a little bit, and have we missed anything? No. I'm going to hit submit. So let's see what comes up here. So that's a not very well thorough, but we call risk tolerance questionnaire is what we call it in the industry. That certainly didn't challenge us much here. Maybe ask us more questions. Let's see what we got. Thanks for letting us help reach your financial goals. We're reviewing my answers. Okay. I always like my answers to be reviewed. And this is what was kind of interesting to me, actually. I ran through this before I did this video. And it's just, obviously, you got all USAA funds. I don't have whatever. I mean, you're going to T. Rowe Price. You're going to have all T. Rowe Price funds. You're going to a Vanguard. You have all Vanguard funds as well. But they have large cap growth, large cap value, international, emerging markets, corporate bonds, and some corporate and government bonds. Not a bad mix. Let's view more choices. And what is conspicuously absent, and this is what I don't understand about USAA, I don't get, their index funds are absent here. So USAA has what's called an extended market index. They also have a large cap index, S&P 500 index, excuse me. And both of those are absent from their portfolio recommendations. And that's just, I find that to be odd. Don't get it. Value fund is large cap. Let's see what the growth fund is about, because what was conspicuously absent there too is any exposure to small companies. And so I'm looking at the growth fund, and I want to see the fees first and foremost. So there's the fees, 0.99. Large growth right there. Large growth is what the account invests in. 9.44% is the total return over 10 years. In holdings, let's see what the holdings are. I want to go down here. Number of holdings, 93. Bear me just a second here. And, okay, here we go. I got to click on this to get... Yeah, so all right, so this capitulate, look at that. The green is large cap, so all large cap with a 3% into mid cap and none into small. That's a problem. I mean, there's no other way to look at that. I mean, there's no small caps in here. I appreciate they only have 6 funds. That's good. But there's no small caps in their portfolio whatsoever. Let's see about the aggressive growth fund. This model here, if that gives us any small cap exposure. Aggressive growth. Let's see what the fees here are. 0.81, so a little bit cheaper. Got 1,200 funds in the category, or I guess that's got to be holding stocks. 9% over 10 years. Let's see here. Holdings. That's a typo. So it's got to be positions they meant to say. Let's go down to capitalization. They do go to stocks of large and mid-sized companies. Let's see what capital or exposure is. So far, unless this has more exposure to small companies, let's see. Oh, yeah, same thing. Large companies. Now, yeah, that's odd to me. All right, so I'm not sure that's odd. So they don't have anything in terms of their recommendations that's geared towards small caps. No, nothing. Well, that's weird. So let's just real quick, I'm curious to see where we're looking at USA funds. I want to look at the S&P 500 index fund, relatively speaking, to the other two that had given us. So let's go down here and see if it gets us view all funds. We're going to view all funds and see what comes up in terms of some of the other funds that they have. So the USAA, they have the index funds, and neither of those are in their recommended portfolios, which is odd to me. I don't know why that would be the case. So I want to go down to just give us a thing for index funds, index right there. So let's click off that and click on this. And USPX member shares right there. Yeah, so here's the index fund. Has done better since the last 10 years in either of those two funds, I believe. Let's take a look. Fund detail. And this guy, the expenses are 0.25 after reimbursement. So it's a fourth of the cost of the other two funds. Over 10 years, the 4-star rating, higher rating, over 10 years is 9.24. What was the growth fund? Was over 10 years. Now, you shouldn't invest just based on the last 10 years. Don't do that. But at the end of the day, if you're going to compare apples to apples, and one is, this is, 9.24 as well. Yeah, so there you go. So this is the growth. No, that's the index 500, excuse me. So this is the growth. Well, that's the index 500. Hold on just a second. I want to go back to the growth fund and see what that did for us. So the growth fund is not that. Let's see here. Yeah, right here. All right, so the growth fund is about 4 times as expensive as the S&P 500. It did a little bit better over 10 years. Not much, but a little bit better. But either way, that doesn't have any small caps. I'm not sure why that's the case. So let me just look at something else here. I think it's a big deficiency, actually, about not having exposure to small and more so in the mid-sized companies for a truly diversified portfolio. Let's just go to, I want to look at other funds they have. The extended market index, USMIX, is the 4,500 stocks of the Wilshire 5000. The S&P 500 is the 500 stocks of the S&P 500. The Wilshire 5000, otherwise known as a total stock index, contains 5,000 U.S. stocks comprised of the 500 of the S&P plus the 4,500 of their extended market index. So like Vanguard has a fund called the total stock market index, which is literally the extended market index plus the S&P 500 combined into one fund. It's probably about 75% S&P, 25% extended market index. So I'm a little bit more of a fan of having the funds divided up as opposed to one, because I like to maybe make it a little bit more weighted towards the small caps as opposed to just 75% large and 25% small. So I'm a little bit more favorable towards to what USAA is doing with the extended market index as one fund unique and the S&P 500 as a second fund unique. So I like that. So let's just curious why they don't have that in their mix here. And again, because it's an index fund, the expenses are pretty cheap. This is less than 0.5%, which is pretty cheap. Again, they have funds in the category. I don't know why they're using that term funds, but so if you look at here, the 10-year average is 9.88. Again, I don't want you investing based on 10-year average, but it does give you something to consider. The facts are, if one fund was way high, one fund was way low, it doesn't mean a whole lot because we don't know what's going to be over the next 10 years, but it does give you something to think about. Over the last 10 years, we had a down and an up. Well, I guess actually now that we're knee deep, we're still knee deep. And if you look 10 years from that ago, it's been all positive now, because basically 10 years ago was April of 2009, so we missed now these 10-year averages are missing what the October 2007 to March of 2009 crisis were. So I hate to say misleading, but it'd be interesting to see if you look over like a 15 or 20 year to see what these funds have done when the market was just getting hammered. And off the top of my head, I don't know. That's interesting to me, though. So basically, because we're March of 2018, this goes back 10 years. That would be it's going to be 2009, 10, 11, 12. So basically, the numbers that you're seeing excludes now the market decline of 2007 October to March of 2009. Yeah, it's too bad. So it'd be interesting to see what it was if he threw that in there. I'm not going to do that here, bore you to death. But anyway, so interesting about USAA, they don't have any index funds in their portfolio mix. And I don't like that. And they also don't have any small cap access exposure either. And just look at the emerging markets fund here. Just what I'm thinking about. They do have 6% exposure to emerging markets. Ooh, look at that expense ratio, 1.51. Most international emerging markets are going to have high expense ratios. Again, the 10 years one. Again, that's why I don't look at the 10 years so much in terms of, I can't invest in this because it's only 1%, whereas the other ones were 8, 9%. Well, this is emerging markets. It's a different area of the market. So I wouldn't pay that much mind. The fees do concern me, though, that's for sure. 1.51? That's not cheap, even for an emerging markets fund. That's not cheap. So I'm not a big fan of what they're producing here for their results in their portfolio planner. That doesn't sit well with me. So basically, all in, you're looking at probably 1% fee. That could be. I think they could do a better job. All right, so let's look at something while we're here. Let's go back. I want to do what they recommend for their digital investment advisor. That's the robo-advisor stuff that everyone was real keen on a couple of years back. Seems to have lost some of the speed of implementation. Actually, some of the big firms recognize that human beings are actually needed in offering advice to their customers. So let's go back here to the portfolio planner. Let's start a new plan and see what they recommend for their digital investment advisor. So what a digital investment advisor is robo-advisor. It's all done automatically with algorithms. We're going to say we have $50,000, but they charge you a fee on it. And I want to grow the money I have. And I want to get investment style. We're going to say aggressive. And I'm going to say I want Did it allow me to do that there? I can't remember. Let's try this. Let's see what it tells me I can do here. I want to professionally manage my investment portfolio based on my goals. I have money left over that I'd like to invest. Let's just see what they say. My net worth is over 250. We'll say, again, explain net worth here. Let's see what they're asking for. So the difference between total net worth and liquid. Real estate. So assets might include real estate. Oh, excluding primary residence. Okay, that's interesting. So they're really looking for your liquid net worth as opposed to your total net worth. So that's interesting. Real estate excluding your primary residence. So I'm still going to leave it at that, but that's interesting. So that's a significant difference because most people's net worth is tied up in their homes. That's interesting, actually. And do I think I'll need the money to cover other expenses? No. What's your tax filing status? We're going to say we're married, filing jointly. We'll say my taxable income is in the 22% tax bracket. And let's see what it tells us here. I want to see what, I guess I get to choose something there. Yeah, let's try ETFs. Let's do this. Let's try USA funds only first. Let's see what it gives us. I think because it's a managed account where you're paying a fee that have index funds in there to at least reduce the fee that you're paying. Let's find out, because you're paying a fee to USAA to manage it for you. On top of that, the funds within the account have a fee internally too, like the expense ratios I just talked about. Oh man, it's the same thing. Yeah, I'm not a fan of that, actually. That's why would they? I don't get it. There's still no small caps. Yeah, I'm surprised by that. So I clicked on more choices. Looks like the exact same thing we just did. So that's interesting to me. That can't be the same thing. All right, so let's go back. I'm gonna go back. I'm gonna start over. That can't be the same. That can't be their managed accounts. It's the exact same thing. I didn't see any difference at all. Let's go to products and hit the advice. Let's try this. We're gonna go $50,000. I'm gonna click on this guy here. Maybe I want. No, I did. I want to professionally manage my investment portfolios. That's interesting to me. They came up. So the managed portfolio that USA uses is the exact same thing as what I can do on my own. I have money left over, like to save and invest. Moderate, all that's still in there. Let's hit submit. So I'm surprised by that, actually. I don't. It still comes up here. So there's something with the tool that is kicking into kind of default right there and towards their portfolio planner. Yeah, I don't get that. So that's odd to me. The exact same thing. So I'm not a big fan of that. So let's go. I'm going to try to go start over something brand spanking new. So that's odd. So let's go to products and let's see what USAA can do for us in terms of their digital. And what's it going to bring up here? Digital Investment Advisor. There we go. All right, there it is. Digital Investment Advisor. Let's see what we got here. So that was interesting. I can't imagine both the managed portfolios and my self-directed portfolio are gives you the same allocation. That can't be. So I'm confused by that. It didn't show actually either the fees either. So let's see what. All right, let's go. Let's see what we got here. Okay, got it. Let's open my investment account. Sounds good. Let's investing. Okay, sounds good. Let's keep going. All right, enter what you want to name your account. Josh account. Okay. This is what I'd like to invest going forward. Okay, I'm all set. What's a goal? If you haven't decided how much, looks like how much we have in there, say $50,000, about that much. What would you like to start with today? We'll say $50,000. See what it tells us here. About that much. Looks like you enter amount greater than the goal you set earlier. Really? I said earlier is a goal. All right. Well, that's interesting. That's what I put in there. All right. So that's I'm all set. I clicked on that. Josh account. All right. Was a goal. $50,000. All right. Well, I'm not sure what they're telling us here. So let's do what, $10,000? About that much? Okay. So, that's not what I'm. Wow. All right. So let's do this again. I want to say I want to put $50,000 in there. Why is it not letting us do that? 50,000 defaulted to 50. Do 50,000 here. I guess you got to click on that. All right. Looks like you entered an amount greater than the goal you set earlier. Wow, that's would you like to go back and change? Okay, I'm not sure what they want us to say. So let's do $10,000. Yeah, that's they need to get their IT folks on this. This is an exercise in futility, that's for sure. All right, so I want to go more aggressive. There we go. Let's see what we got. Show me the portfolio. This is odd to me. Aggressive portfolio. View more details. I'm an investment buff, I guess. Okay, so let's click on this. Yeah, so here they're using their ETFs in this guy. Do we see a fee on this? Let's go down here. Yeah, I don't see a fee. That is odd. 2% money market, 48% S&P total US. Remember we just talked about total market versus the S&P 500. So I like this a lot better. I don't happen to see a fee. Now, obviously, I'm kind of looking at this very quickly, but that's interesting. So their digital advisor portfolio, where they're going to do the rebalancing and all that, is they're going to do it for you for a fee. And I have literally no clue what the fee is. Which is, and they use the ETFs, which I like too, because they're going to be cheaper, certainly cheaper than the USAA mutual funds that they're putting in when you did the portfolio planner, like I did originally. And then on top of that, like when I did the managed account thing, because it said USAA funds only. It said, and then it also said USAA funds only, USAA and non-USAA funds plus ETFs. So yeah, I don't like this. It leaves a lot to be desired there. It doesn't tell you anything. All right, let's see maybe it'll tell us here. What is a managed portfolio? All right, I'm not a fan of this. Yeah, so I'm gonna get out of this guy. That doesn't make me all that fond of what they're doing there. The one thing I do like about the digital investment advisor is I do like the exposure to ETFs. So those are probably going to cost 10 to 15, maybe 20 basis points. So let's just say the DIA advisor is roughly 35 basis points to 50 basis points, which is basically 1/3 to 1/2 of 1%. You throw 10 basis point expense on the ETFs, maybe in 20. So you're basically looking at your all-in fee of 1/2 to 0.75% for that portfolio. The USA fund that we did originally, the average is probably about 1%, where you're doing it all, and nothing wrong with that, but had no exposure to small caps. They had a higher fee with no exposure to small caps. All USAA funds, I don't have any problem with that, but a little bit higher expense and not as well diversified, frankly, as it should have been. Secondly, we went to the USAA managed portfolio, just all USAA funds, and that was the exact same portfolio as the first one. I don't know if that's a glitch. I mean, I literally clicked, I want USA to do it for me, and it took us to that. And finally went to the DIA, the Digital Investment Advisor portfolio, and that had more exposure to small caps, more diversified, cheaper I believe, in terms of the overall fee, even comparatively speaking to the USA Portfolio Planner, where you do it yourself, just it was an odd way to open an account. I didn't like that at all. So of the three, as you see here, and then finally the first one didn't have any index funds. There's nothing in there. It didn't have the lower cost index funds. It gave you all actively managed funds. So that's odd to me. I don't. It's something just not doesn't make me have warm and fuzzy inside. Of the three, though, I'd go the DIA, the Digital Investment Advisor, simply because it had automatic rebalancing, automatic indexing. You see what I'm saying with the iShares, and USA is rolling out some ETFs, so presumably those will be in there at some point as well. And it was more diversified. So when you look at USA Digital Investment Advisor versus the USA Mutual Fund portfolio, it was actually cheaper. It was done automatically for you, and it was more exposed to different asset classes in terms of small caps. So, in my opinion, I'd much rather do the DIA for those three reasons. It's just more of a cumbersome in trying to set it up. I just got to try it real quick, and I want to get back on to managed portfolios because I can't believe that's the what they gave us. That I don't get that. So let's go to managed portfolio that works for me. Let's try the ETF one this time. So let's see how we do that. Get a recommendation. And let's see what they come up with. $25,000 is a managed portfolio. The DIA, what did I say, 2,000? I mean, you can have basically a managed portfolio for you with ETFs for less than, basically your all-in fee is what, 1/2 to 3/4 of 1%. That's pretty good for $2,000. That's pretty good. And again, we're going to say $50,000. This is the managed portfolios of the ETF. So we're going to say we're trying to grow our money, and we're going to say our investment style is aggressive. And again, it gives 80 to 20% stock to bond mix. We're going to say we want professionals to do it for me. We don't want to do it our own. And we're going to say we have some money left over. Like same before, our net worth, we're still going to say is $250. But again, that doesn't include your home, which is odd to me because that is your net worth, is your house. I know they're saying probably because you're not going to liquidate your home if you went to hell in a handbasket. But net worth is your home. I'm not sure why they wouldn't use that. Married filing jointly, and we're going to say our income is in a 22% tax bracket, and we're going to say this time ETFs. So let's see what it comes up with us here. A little bit cumbersome, actually. I'm in terms of getting a clue of the three different offerings. A little bit more cumbersome than I'd like. So, all right. So here we get 81% in stocks, 17% in bonds, and 22% cash. Exchange traded funds. Let's see what are. All right. See, a lot more diversified. Small cap. I don't know why that's weird. Why would they not do that in the other one? So we even got some Vanguard ETFs. We got some iShares, presumably again because USA just rolled out their ETFs. So there'd be some USA ETFs in here. I don't think it said the fee, did it? So these funds right here, let's just click on one. We'll click on the small cap ETF, just get a gauge of the expense ratio. Let's see what it says here. I'm looking for the expense ratio. Now, again, go back to my video on that expenses. There's more. Where is it, man? Good night. There's more to the just expense ratio for cost of a mutual fund. And my video I did on that, it should be right down here, but I don't see it. Shows you that actually the study showed about it is almost twice of what you see because all the trading costs and whatnot. I don't see an expense ratio on here, my friends. So let's just see if there's something. If y'all see that, other as asset class. So why would it not be right here? There's assets. BlackRock's the advisor. I don't know. That is weird. So they don't market cap, style, inception date. I'm going to hit one other thing here. That is odd to me. No news. I don't care about the chart. I don't see an expense ratio. So that would have jumped out at me as being expense ratio right there, but I don't know that to be true. So I don't know. I'm going to say if it's an ETF, typically it's about 0.2% maybe. I'm just going off my own thought on that right there. No, that's not it. That's percent of top. So I don't know. I'm not sure what that is. So that's odd. So anyway, let's see here. I want to go back. Oops, bear with me just a second. All right, so let's cancel out this guy. All right, so at the end of the day, let's kind of cancel out this guy. Back. There we go. Oops, I want to exit full screen. All right. So at the end of the day, the USA stuff, well, I don't want to say it leaves a lot to be desired because I don't think that's true. I think there's some stuff in there that's pretty good. Oh, I did want to go real quick while I'm doing this. I want to see what USA, the ETFs are doing now because USA just rolled out some ETFs. And let's go to back. Let's go to USAA right here. And I want to go to USA, my products, and their ETF investing right there. Let's see if they show us their USA ETFs yet, because they literally just rolled these out. At least I got an email from them just, I think it was last week. Right here. Sweet. Meet the USA ETF family. All right. So this is interesting. USA is taking a page out of the Cambria Med Favors book of momentum and value investing on their ETF. So that's interesting to me. Now they got, 5, 6 in there? Yeah, they got 6 ETFs. So I guess USA said they can't compete with the Vanguards and the iShares of the world. So they're going to go after a different strategy, which is momentum ETF strategy. I think there's some validity here, actually. I don't know anything. I literally, this is the first time I clicked on this webpage of USAA's ETFs. But I am familiar with the guys over at Cambria Research. They have Cambria mutual funds and ETFs. They do a ton of stuff on momentum investing. And it looks like USA has kind of bought into that, which is interesting, actually. Provides exposure to value momentum factors. Seeks to provide investment results that correspond before fees and expenses to the performance of the value momentum blend index. Oh my lands. There's actually a value momentum blend index. Yikes. As of 2017, the market cap of the issuers in the index ranged from 3.4. So that's quite a variance there. So that's interesting. I just want to see expense data. Let's see what a USA, 0.2. That's pretty good for an ETF that's actually actively managed trade. I'm not saying it's good or bad. If anything, I still favor passive investments. I do, but I find that interesting that USA has followed that model actually of the value of momentum play, which causes a concern because there's always a new way to skin a cat. And once that one way to skin a cat has become well known, guess what happens? That way it comes yesterday's news. Because the market is the most efficient animal there is in terms of, portfolio analytics. There's literally hundreds and hundreds and hundreds, thousands of people analyzing different market baiting methodologies. And it used to be dogs of the Dow, value, all this as they swing that way. The market says thank you, and then they make it to go this way. Then people go that way, they say thank you, go back. So I'm not saying you should buy. I just find it interesting that USAA would go that route, but I'm not saying you should. I literally have agnostic on it. All right, so that's the store of USAA. At the end of the day, I think at the end of the day, the portfolio planner was disappointing. The digital investment advisor was of interest to me, for sure. But the digital investment advisor, the how you set it up was just I didn't like it. It wasn't very user friendly, in my opinion. Now, obviously, I'm doing this on the fly, so I'm just giving a cursory look, and I still have no clue what the fees are. The actively portfolio managed accounts, either the ETFs or the mutual funds. Again, I don't know what the fee is. My presumption, having worked there before, is around 1 something. I think all-in fee 1.5 to 1.85 when you factor the mutual funds are in there. The ETFs are probably going to be a little bit cheaper simply because they do use ETFs, which are cheaper than the mutual funds as well. The portfolio planner, the mutual funds that you do on your own, and the managed account USAA Portfolio Planner, USA funds neither had exposure to small caps, and that's a big problem, frankly. I don't like that at all, and I would probably not go that route. I'd either do my own again, we talked about the S&P 500 index and extended market index, using a compilation of those, maybe using some of the models that USA gives you in terms of emerging markets, as well as the international fund, whatever. But you want exposure to small companies, my friends. Historically, small companies have outperformed large, and that just inherently makes sense because small companies, no one knows what the next Microsoft is going to be. Right now, we just don't know, but there will be a next Amazon, a next Microsoft, and it's going to be in the small capital arena. That's all there is to it. We don't know what it's going to be. But remember, for every next Microsoft, there's 10 circuit cities that go kaput. And so that's why we want a diversified portfolio. So if you're buying the next Microsoft, you're also not going to get hammered if it actually comes out to be the next circuit city. So you just got to be very, very careful there. So next time we'll go into Vanguard. And here's the Vanguard stuff right here that we'll go into. And then the time after that, we'll go to T. Rowe Price. And here's the T. Rowe Price stuff. And then we'll go into Fidelity, and I'll try Schwab. Cover the big five in terms of no load funds, which also has advice that you can pay for as well. So it'll be interesting. So stick with me. This is Josh with Heritage Wealth Planning. And don't forget, thumbs up. If you have comments, questions, concerns, put them in the notes. Don't forget to subscribe. And as always, just let me know what you think about this going on. And we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.